Welcome back to the Market Insights webinar. This is Kevin Prince from BMO Exchange Traded Funds, and I want to say thank you so much for taking time to join us today to get some further insights of the overall marketplace. And I also want to thank those people that took the time to send us some questions, because that again helps us develop content as well as it gives you a chance to get some further insights more tailored specifically for you. So with that, let's get in today. Now, right off the bat, I want to highlight, not recommendations are going to be handed out today, neither specific advice. We are going to try and provide you some insights to the overall market itself, and specifically to a tailored view of ETFs. Now, my guest today, Mark Race from BMO Global Asset Management. He's actually head of product for BMO Global Asset Management. And what we're going to do today is we're going to talk about like a year in review to give you some perspective of what this year we just went through, and from a lens again one more time of ETFs. Now, we always start these things off with a little bit of tools. Well, I'm going to highlight today, hopefully a tool everybody's very familiar with, YouTube. And the reason why I'm highlighting this is we're going to take a break after this session, and we're going to come back on January the 8th. So for those of you out there that love the Friday sessions at 1 o'clock, well, no problem. We have over 37 listed videos with unique content right now posted on YouTube. All you simply have to do is go to YouTube and type BMO Market Insights, pick the topic you want to get more insights on, and there it is for you. Again, 37 unique topics to pick from. Please take the time to enjoy it, and thank you for those who've already listened to some of those in the past. With that, let's get into it. Mark, let's start off a conversation about a year in review around flows, because that kind of gives perspective about the year and where the money went to, I guess, in our industry. And I hear it's a record year for the ETF industry. Can you give us some insights flows-wise, please?
Sure. Thanks, Kevin, and thanks everyone for listening in again today, our last one before the holidays. So glad that you could join us today. Looking at ETF flows, it has been a record year here in Canada. I think if you look across the year, and we'll get into it, it's sort of been the tale of many years in one. When you think back to the March volatility and correction, and then the roaring market since. If you look at ETF flows, where we're now at 250 billion in Canada, you do see it spread out across regions in terms of geography for equities, although you will see that international equities pulling ahead. Fixed income very well represented as well, capturing quite a bit of the growth in the market. And then a couple of smaller areas that I think are going to take off, potentially commodities if we do start to get some more inflation, but as well multi-asset. I think that's the new area for ETFs, the balanced ETFs that are really going to take off. So if we look at the flows themselves, about 21 billion going into equities, about 12 billion going into fixed income, small remainders after that. So pretty balanced across asset classes, but a really strong year of growth across the Canadian ETF market.
Thanks, Mark. Maybe let's dive a little bit deeper here. Let's take a look at the equity flows themselves, and maybe you can give some insights to us about where that cascaded to over the year.
Sure. So if we break down equities a little bit more, pretty evenly split between Canada and the United States. Of course, we really saw the US market roar ahead through April, May, June. Canadian market has slowly been picking up against that as returns are diversified. If you go a little broader into international, that market's been a little slower to pick up. But emerging markets has been the interesting one, where of course China dealt with the COVID virus early. I won't say got it under control, but got back to some level of normalcy first. And so you saw outsized returns led by China and emerging markets, a lot of investor interest picking up there. If we then go and look at factors, no surprise, market cap weighted, which, picking up the market as it is, continues to be the largest asset gatherer. Dividends is an interesting one with pretty high market share and even positive growth, considering that dividends have really underperformed this year, potentially due for a bounce back in next year. We shall see. Low vol struggled a little bit as well. You didn't see that same correction versus the market because of the concentration of returns. So you are seeing a little bit more of a spread across the factors. In terms of sectors, no big surprises. Flows into financials, that's to capture growth. In materials, so think of something like gold in order to hedge against inflation and potentially hedge against market risk. And if we look at these flows overall through the course of the year, I think that starts to reflect what's gone on in markets, which might be quite different in 2021 if returns start to get more diversified. Thanks, Kevin.
Well, thanks for that. And that's a good context of the year where the money went to. Well, let's take a little perspective of the year we went through. And one of the things that we certainly came from this year is a lot of ETF launches. I think there's about 139 ETF launches this year, which may or may not be a record. I think you know better than I would, Mark. But there's some key themes that came out of the launches this year in the ETF industry. Can you walk us through a few of the themes, and specifically in this case, start off with maybe ESG as a theme?
Yeah, I think ESG is probably the #1 new ETF theme this year. Ourselves included putting some product out in the space just to give people the opportunity to invest with a responsible overlay. I think investors are learning that you don't necessarily sacrifice returns to invest via ESG, so that's been really important, allow people to invest to align with their values. And what you're seeing is ETFs, across geographies and equities, and now even into fixed income. And we were the first to bring out a balanced ETF to really give people more choice to invest via an ESG lens. So we do think this is something that's going to really continue to grow over the next few years. So what I would say is you've seen a lot of pre-positioning of products, across the providers. But if I look forward a number of years, I do really think that this will be a big part of the ETF market and part of everyone's portfolios. Looking at what we launched back in January of this year, regional equities, so Canada, US, international, and of course a global wrap, fixed income, corporate bonds in Canada and the US, and as well as I mentioned, the first balanced ESG ETF, 60/40 ETF, and an area that we're well known for, of course, covered calls, bringing out a global dividend-based covered call, ZWG, which has been very popular in the market since launch. So I think it's quite important coming into this space to make sure that there's enough choice for investors so they don't feel that they're certainly buttonholed into a certain exposure to really have choice that way. Thanks, Kevin.
Yeah, it has been good to see the portfolio construction tools of ETFs really come into the marketplace. Not a specific product, but a choice of products that are tailored. I think another thing we've certainly seen is, and certainly built upon the demand year over year, is that portfolios are evolving and tools are evolving around portfolios. I mean, one thing we've certainly seen over the number of years is that to get the same level of return, the portfolio construction within one's portfolio certainly needs to be different than it has in the past, and moving towards more of the equities and more of the risk side to get that same level of return. Now, Mark, maybe give us a little insight about some other things that come in the marketplace, not your traditional equities, but maybe the alternatives and the trend around that coming to the marketplace.
Sure. Well, I think the biggest challenge is finding income, right? So we're seeing fixed income yields, really collapse down to historically low levels. We're not negative like some regions in the world, but certainly our payouts are not what they were even a year ago. And so for yield-oriented investors, this continues to be a challenge where now you're holding fixed income, I would say, as a safety net against potentially equities, but at the same time, some of that safety is eroded because, of course, the yields are lower. So people looking for things like alternatives or alternative-based products to really change some of the risk metrics of their portfolios and to add yield. So ticker we call ZPay, which we brought out again at the beginning of this year, premium yield ETF. This is a great example of that and has proven to be really popular in the market. And what this portfolio does is it has a 30 to 50% weight in equities, generally speaking, but it uses option strategies around that with covered calls, with puts as well, to really be nimble in the marketplace. So it doesn't have a full equity exposure, but it's got a higher yield and a dynamic equity exposure. And of course, as well, on a concentrated basket of higher quality names. So in doing so, that's giving investors a different tool with a different outcome than a true or a traditional equity or fixed income. And that's the type of thing people are looking for to really improve their overall portfolio, something that's more dynamic in the marketplace, kicking off some yield, and doesn't act, to the same degree with a high correlation to either equities or fixed income. So this has certainly been a success for us out of the gates, and is meeting a lot of needs for investors. Thanks, Kevin.
Thank you for that too, Mark. Now, of course, we all a challenging year. We certainly went through the challenges back in March. And so let's take some time to reflect upon the correction and what it meant to have ETFs in the marketplace during the correction. And I think we also just start off a little bit of history here if we can, Mark. Maybe give the history around the creation of ETF and what that meant to the market first and foremost.
Sure, I'll move through this quickly, Kevin. ETFs have actually been around since essentially the beginning of the 90s. Why did ETFs come out? Well, really as liquidity baskets to diversify for institutions that were getting challenged by derivative markets and equity markets and having them behave in a similar fashion. So an ETF gave a different tool to get market exposure and to therefore diversify market participation. And that really evolved over the years where first advisors got interested, and now end investors, and ironically we're seeing a pickup once again in institutional use. So ETFs are really for anybody out there to get a quick, efficient, diversified market exposure. And when you turn around and look at turbulent market times like March of this year, ETFs really proved their value once again. And I look at that two ways. One, in equity markets, they continued to trade very effectively, very efficiently. But second, in fixed income, and we'll get into this in a sec, they continued to trade when perhaps the underlying bond market was quite frozen. And the chart that you've just thrown up here with traded volume, so this is the dollar amount going to ETFs. You can see when markets get choppy, so late February through March, all of a sudden there's a big jump in the dollar traded in ETFs. And what does that tell you? It means ETFs provide liquidity when you need it. So when people needed to trade, they weren't looking to underlying securities or other baskets of investment products. They were using ETFs to quickly rebalance portfolios, to look at their equity fixed income mix, to potentially raise cash if they needed to for margin calls or for anything else. So when I look at this chart, that spike through March is a clear validation of the use of ETFs for people to get liquidity when they need it. Thanks, Kevin.
Well, let's flip the gears too now, because staying the same theme of the correction. I mean, one thing we of course saw too is the impacts on fixed income, both in liquidity as well as even before the market exposure. So walk us through what was going on in the fixed income aspect of ETFs and maybe the broader fixed income market in that March 23rd challenging time period.
Sure, and I honestly think this is the biggest proof point for ETFs. And if I look forward a couple of years, I think more and more investors will use ETFs for fixed income as opposed to direct bonds, mutual funds, laddering, things of that nature. Why? Because they give you the liquidity when you need it once again. So the bond market very much froze up in March, and that essentially continued on until the Fed, until the Bank of Canada started making announcements supporting the market at the end of the month. Well, there was a period there where essentially the bonds themselves were going no bid, no ask. So the only thing that was trading was the ETFs. And it's quite interesting when you look at the price dislocation of the ETFs. People think, hey, that's a problem with the ETF. Its price was moving, but it's the market or the NAV wasn't. I'll say it's quite the opposite. The ETFs were price discovery, were showing what was going on in the market, and the NAVs that weren't moving at all, the price of the ETFs really was not reflective of market conditions. So once again, it's a great proof point that the ETFs were working even when the underlying market wasn't.
Thanks for that, Mark. And then you already talked briefly there. Like one of the big themes we also saw beyond the correction was then, of course, Bank of Canada and the Fed more coming into the marketplace. Talk to us about what that meant for the market itself and what it helped in regards towards ETFs too.
Well, sure. For any risk assets, it provided a backstop, and I thought it was quite interesting because we got these announcements of purchase programs that were going to get launched, that they were going to buy X amount across asset classes, and it wasn't actually the purchases themselves that caused the markets to settle. It was the announcement that these programs were going to occur immediately caused the markets to calm down quite a bit, to the point where a lot of these purchase programs have actually been curtailed and didn't buy nearly as much as they thought they would out of the gates. And so while you did, of course, get that immediate dislocation in the middle of March, really since then, and this has caught a lot of people by surprise, considering what's been going on with COVID, what's been going on with the economy and shutdowns, markets have marched right back to levels that they were at, and even are setting new highs, setting new highs in equity, and corporate bond spreads have come right back into where they were pre-COVID. So, that backstop is really the tale of the year, and has caught a lot of people by surprise that markets have just marched higher.
Definitely a trend, and good to see the support, though. It was definitely needed. Another key thing we saw this year, Mark, was concentration of securities. We see that, of course, with inside the Nasdaq, and to a certain extent inside the S&P. And what I mean by concentrate is that some parts of the market did very, very well, while other parts of the market may have not done as well during the correction. So maybe talk to us about that briefly, and I also maybe talk about mid and small next too, for that matter.
Yeah, and we get a lot of questions about this, Kevin, where people are turning and saying, well, how come my ETF or my fund or my holdings haven't gone up when the market has gone up? What people have to realize is it's very much been, the technology and the new economy names that have driven this recovery. So it's your Teslas, your Apples, your Amazons that have benefited, whereas your more traditional bricks and mortar type companies really haven't caught that trade at all. And you see that with the Nasdaq, which is a more tech-oriented index, outperforming the S&P. But even within the S&P, those top contributing names, again, Apple, Amazon, have driven the majority of returns in that index. And this has been a factor across portfolios and factors where, things like lower vol or dividends have underperformed. Or if you look and say the Canadian market has underperformed the US market because we just don't have that same level of technology names and new economy names. So that's really been the story of the recovery. And we'll just have to see how that plays out in 2021, whether that diversifies or remains concentrated in these companies.
And then part of that too, talking about diversity and concentration. We had the S&P on some time ago, and they really kind of highlighted here. Maybe you can talk to us about briefly about, the mid cap of the marketplace and the small cap relative to the large cap, where that concentration is starting to come through in the S&P. Give us some insights on that there, Mark.
Well, and absolutely tying back to that last point, we have seen that outperformance by the large cap, the S&P 500, and it's been driven by those market leading names. Whereas if you go to the mid, the small, traditionally, when you get a market recovery, those tend to outperform when it is diversified across the marketplace. We're seeing a lot more interest in the mid and the small now that large cap trade has played so well in 2020. But looking at growth going forward, getting those smaller companies, those more leveraged to growth companies, and just as importantly, I think, if you're focused on the US economy, the smaller you go from large to mid to small, the more of a domestic exposure you get. Those types of companies are starting to appeal more and more to people now, and we are seeing heightened interest, particularly in the small, but I'd say it's also factoring in on the mid, where people are realizing that large cap return has really been driven by those top 5-6 names. Thanks, Kevin.
Thank you for that. And then, of course, if we're talking about one of the things more recently, I guess we actually just recently finished it, hopefully, was the U.S. election, of course, and the aftermath about that. Talk to us what that meant to the markets and maybe some of the changes it meant to the markets and the rotation it meant to the market too.
Sure, and I guess it's a debate point if we are finished or if that's still going on. Certainly, things are progressing. The one thing that's still outstanding are, of course, the Senate runoff votes, which are going to be quite critical in January down in Georgia. Why? Because that would potentially create a check on the incoming Biden team, depending on how that vote goes. However, if you look at how markets have responded, it's actually been obviously quite positive as we've continued to set new highs. I think what's critical for the economy right now, and is of course the number one thing that everyone seems to be focused on, is what's going to go on now going forward with stimulus packages and helping out Main Street and not just Wall Street. So we'll see how that plays out. That's critical for markets. In terms of themes, you think once again something like ESG will be at the forefront of things. Healthcare, of course, as well. If we get a broader recovery, that might mean quite positive results for banks. So that's got a consideration of financials as well. So it's got the possibility of really being positive for markets into 2021. And if you look at the backstop that's being provided, through monetary policy, I think people are far more comfortable right now taking on equity risk. And that's why you're seeing a lot of those projections for market levels in 2021 actually coming in quite high. So I think people are pretty constructive on the equity markets on the back of the election. And of course, under the assumption that the COVID vaccine gets out there and that the economy can get back to work. Thanks, Kevin.
Thanks for that, Mark. And I think it was a good summary for all of last year. One of the things we definitely know and kind of learned through last year is that the need to stay invested, right? Certainly change the portfolio as you feel and your comfort level across the board, absolutely. But, we've seen crisis over many, many years. And this is a nice little chart that kind of showcases that. And we're not even including the most recent dip and the most recent recovery in here. But what you're effectively seeing is that power of staying invested year over year. And we did a little bit of relative example here relative to traditional GICs and inflation for that matter. But definitely one thing to think about as last year kind of resonates that we went through a year, but staying invested, certainly tweaking the portfolio from time to time, absolutely on top of that, but does be a good lesson for everybody on a go-forward basis. With that review of last year, let's take some time and shift gears and take in some of these questions. We want to make sure we cover them off before the end of this year. So Mark, got a bunch of good ones coming in here. And again, thank you for all those people out there that took the time to send us some questions. So let's kick off first and foremost in regards towards the S&P 500. What is one of the easiest way to access the S&P 500 at this point? And then on top of that, Mark, talk us a bit about currency and the ability to switch currency back and forth and fees associated with products like that, and maybe additional fees regarding to switching currencies in those products.
Sure, thanks, Kevin. And in here we see, as we just spoke about, a prediction about the S&P going higher. A simple way to invest in that. Well, we happen to have S&P 500 ETF, which we had up on our previous screen. So our ZSP ETF would give you exposure without a currency hedge, so therefore exposed to the US dollar as well. Whereas our ZUE ETF would be the S&P 500 hedge back to Canadian dollars, so taking out that currency effect. So depending on how you view currency, two different ways to invest in that. And of course, if you have US dollars, we also have the ZSP.U ETF, which is for US dollar investment. So that's the easiest way to go about it. You're getting that in an incredibly effective low price, MER coming in around 10 basis points to get full market exposure. So that's probably a #1 ticker for me to just buy and hold for the long term. You're really getting exposure to the US large cap market. And then moving between currencies, I think that is something that becomes a trade. So you're buying and selling. My own particular view is that you don't want to be moving that too often to have trading costs against your ETFs. I think you need to have your own longer term views on currency and potentially park a little bit more in these as core ETF exposures. Thanks, Kevin.
Thank you for that. Just advancing here, bear with me. Now, person here is looking at building their own kind of customized portfolio for their kids, and very good, nice to be done. Ultimately looking at bringing in a few tickers here, ZGQ, quality one we've been talking on the show, as well as the Vanguard and then the broad Canadian equities. Now, Mark, let's get your thoughts in towards that, and maybe not specifically the tickers, but building a portfolio. And then talk about here too, also a little bit about the rebalancing considerations too over those next number of years.
Sure, thanks, Kevin. There's quite a bit in this question. #1, I'm seeing an all equity exposure. So, a younger investor, that certainly makes sense. So always think about your own risk profile and your time horizon when you're investing. ZGQ, that's our global quality. So that will be biased to the US because that's where the higher quality companies are these days. Keep that in mind. VFV, that's Vanguard S&P 500. So of course I'll tell you to use the BMO one, but again, a US exposure. And then ZCN is our Canadian equity TSX composite. So I'd say first off, you're certainly North American biased here, and that may be deliberate if you got a view on the US versus the world. I would say something like ZEM or emerging markets might be something that you'd consider to add into this mix. I'm not seeing weights here, so it makes it a little bit hard to comment on. And then across the accounts, you'd be more effective to hold the Canadian equity in the taxable accounts and the non-Canadian in the tax shelter, just because of course the Canadian dividends would get better tax treatment here. If I start to think about things like rebalancing and really holding them for the long term, yes, you can do it on your own. However, you might be better off actually holding a balanced ETF or an all-in-one ETF ticker, which of course that global quality ticker ZGQ could do for you. But you could look at something like ESGG, our global equity ESG product, which rebalances within the ETF so that you don't have to do that yourself. So something to think about depending on your own view on rebalancing. But overall, looking at this mix, broad equity exposures, nothing here that sticks out to me as something that you couldn't use for that long-term investment. Just keep in mind where those market exposures and those biases are. Thanks, Kevin.
Good insight, appreciate that. Let's touch base on technical analysis, because last week we had a great show on technical analysis. I encourage you, if you haven't had a chance to look at it, go back and review. We went through a number of the technical indicators that you could use as part of your investment process. This is a follow-up question taking a look specifically around gold and the gold ETFs that cover equities, Barrick being an equity in there. What kind of key indicators do you look at, Mark, when you're looking at entry points for gold and gold equity ETFs out there?
Sure, thanks, Kevin. I think you can start with a fundamental view and have a long-term view that if inflation is something that the Fed and other central banks are less concerned about going forward, they are signaling the possibility of inflation down the road, particularly with all this stimulus out there as the economy gets back to work. So as a longer-term trade, gold can certainly make sense that way. The question is about technical indicators, though. So I would look at relative strength or MACD. So I would look at trend lines in the marketplace. So you're really watching, how is the 50-day average moving against the 100-day average, against the 200 average, and that gives you an indication of the current momentum or relative strength in that name. So if I look at gold, certainly peaked a bit earlier in the year. It's flattened out recently. So the MACD is actually negative right now, but it is trending back up again. So It's starting to look towards an entry point. I'm not sure if we're quite there yet, but if you use technical analysis, I'll simply say it's looking much more positive right now for gold and gold-related equities. Quick point on Barrick. Of course, it's not just the price of the gold, but it's actually their mining and production out there, where they've had a couple of issues of late. So that's impacting the stock relative to the gold price. But certainly you can do your own research there. But technical analysis is showing we're not quite at an entry point, but it's turning in the right direction.
And Mark, just a second point on that same question. Correlations of gold relative to the S&P 500. What's your thoughts on that?
Sure, and that's an interesting one. Of course, we always think of gold as having basically a zero correlation to equity markets. It's still extremely low, but you are seeing it start to creep up towards 0.1, 0.2. But as a diversifier within a portfolio, it certainly makes sense. I think what you see more than anything is more investors piling into a gold trade, perhaps driving that on alongside markets a little bit. But in terms of the long-term trade, 3-year correlation, 5-year correlation, it's extremely low. So as an equity diversifier, that trade certainly makes sense.
Perfect. And then coming up on, I think, our last question here, Mark. Somebody's certainly looking at emerging markets, but one that keeps kind of a dividend theme to it. What's your thoughts out there around emerging markets and some dividend themes into them?
Sure, thanks, Kevin. I actually think it's quite interesting. You know, we talked about way back at the start about all the ETFs that were coming out. I was surprised to see we're actually up to 25 emerging market ETF tickers here in Canada. So you are seeing that divergence of approaches where you're getting more choice on how you approach emerging markets. I think first and foremost, I think of emerging markets as adding growth to your portfolio. And now that their own economies are really growing up and they're developing, you know, more of a middle class, you're actually getting a diversified return. So I think first and foremost, the market cap exposure in emerging markets. But if you are biased to a dividend approach, I did take a look. One you could think about would be EMV, which is the CI Wisdom Tree Emerging Market Dividend. So there are dividend-focused emerging market ETFs here in Canada. That's a reasonably sizable one that's been around for a few years. So there is choice out there. I think you just want to think first and foremost of what role emerging markets is playing within your portfolio. Thanks, Kevin.
Thanks for that, Mark, and thanks for your support today and participation in this, and as well as all the shows you did in the last year. Really appreciate that across the board. I also want to make a shout out to Prosper. Thank you for all your support too. It's been great working with you. I do want to highlight that we're going to take a break for a little while. I think we all need a little bit of break right now. We're going to be back on January the 8th, again at 1 o'clock. And I'll highlight, we're going to kick off the next year, January 8th, with some house views from our multi-asset team with inside BMO Global Asset Management. So please take time to join us one more time, again on January 8th at 1 o'clock. Look forward to talking to you then. And between now and then, feel free to send us your questions. We'll add them to the next show. Thank you and have a good new year. Cheers.